Hey everybody, welcome to the Walker HT. I am here with my friend Ben Bratrud. How you doing, buddy?
Doing great. How you doing?
I'm doing well. Thank you for asking me.
Yeah,
Appreciate that.
absolutely.
Ben is one of the good ones. I mean, this is probably a little nepotistic because he's also my nephew, but he is a top dog in the mortgage industry. He's smart. He is loyal, just like a top dog would be, but he's also just amazing at what he does. People love him because he is on it. He is there. And so that's why I'm really excited to have him on the podcast today. So Ben, we talked a little bit earlier in the week. So I had the question right now. The big thing that I'm starting to hear from, other agents as we're meeting together. What are some creative ways in this market where things are starting to soften a little bit, starting to level, and yet rates still remain obviously higher as they were, 6, 8, 9 months ago?
Yeah.
You have people, some are saying up to 1/3 of the market, is still in that 3%, 4%, or some people are saying we got 1/3 of the market that are people who bought, in the high. So we've got to get creative with financing if we want to talk about how we're going to get into a home with these kind of competing narratives of higher home prices, although they're starting to soften, and yet still higher interest rates. So
Yeah.
what do you think about that? What have you been hearing about that?
Yeah. No. And it's the highest topic everybody's talking about right now, and the conversation we have with for me, every buyer. I work directly with buyers, and so it's trying to feel out. Everybody's situation's a little bit different. Every market is a little bit different. There was I actually looked up CoreLogic, which measures housing data. Did a survey across 2,500 different professionals of what they've seen in that market, at least in August. So last month, this stuff came out yesterday.
Okay.
And there is, in about 50% of the market, they are still seeing increases in pricing.
Wow.
And then the other 50% seeing a 2 to 3% softening.
Okay.
Just month over month.
Absolutely. Okay? Yeah.
And so, this conversation will depend on the market. Now in Washington here, it's still super strong. We are seeing that, like you mentioned,
For sure.
softening, price drops, buyers getting closing costs paid by the seller.
Yeah.
And these interest rates, from a point of view from a seller or from a buyer is, hey, with the expectation that, hey, rates are going to continue to rise this year.
Yeah.
In 2 weeks, the Fed is expected to hike the rate 3/4 point.
Right.
And so the Fed has come out and said they want that Fed funds rate to be, right around 3.5% by the end of the year. Wow. And right now we're at 2.5%.
Right.
So
let me ask you about that really quick before we jump ahead. I just want to ask you about that because a lot of times, we've seen. It's interesting. We'll see the Fed raise the rate. We won't see that bond rate do anything, or even a couple times so far this year, we saw that Fed rate go up, and we even saw the bond rate drop a little bit. And a lot of people say, "Well, that's baked in." Talk to me a little bit about what baked in means, and how do we predict whether a particular rate is going to be baked in, or can you even predict it?
Yeah,
I don't think you can. I mean, I think sometimes you think you can, but I don't know. You may know better.
I mean, luckily I follow the guys who know better. I follow some of the top rate forecasters for the last decade. And, what I would say is, as much as I like to think I know what I'm talking about, I got a very high school education on this, not the masters that some of these guys have. And,
right.
And so, there is definitely not a direct correlation between the Fed rate and the bond market. What really that is doing, the Fed hiking that rate, is combating inflation, right? And so we want to see that inflation number come down to more normal levels. And the expectation right now is, last year over year, nationally, we saw houses increase 16% from last year to this year still. Right? Which is still phenomenal, knowing that 2021 is, like, 2022 was on, or 2021 was on fire. 22 softened, but still up 16%.
Right.
And we're expecting next year from now until then to be right around 3.8% to 4% increase, not decrease, increase. So
Even in a softening, which is just unbelievable.
Even in a softening, right? Yep. And so to, kind of come back to your question on, the Fed rate versus the bond rate is we're going to see that rate go up, and mortgage bonds. The answer to that is kind of you roll with the punches,
Right.
and know that the purpose and what the Fed has communicated is that yes, we want to curb that inflation, and once they feel like we've curbed it enough, they're gonna lay off of it.
Right.
Okay,
Right.
and so that, bringing back to the other conversation of, for a buyer, is to say, yeah, rates are going to be high. They're not. I mean, historically, they're great. We've all heard our grandparents,
right,
and the baby boomers talk about their 18 to 25% rates.
right.
But nowadays, like the millennial generation,
right,
since they've entered in the last 5 years into buying houses, because all of them wanted to live with their moms for so long.
Right.
Well,
I mean, and that's the same thing. Before I got into real estate, because I got into real estate back in 2008. Yeah. I was in mortgages, 2001, and it was the same thing. When we were selling 6 and 7%, we'd start to complain and be like, "Oh, 6.5, this is terrible." And the old schoolers would come in and they'd be like, "I was selling 12, kid." I'm like, "All right, well, but houses are, a little bit different back then too." But I mean, yeah, it washes out. So, okay, so to that point, when we talk about creativity, because there is no crystal ball, right? We just have the forecasters of what it is. We know the Fed would like to do, and they're going to use the mechanisms that they have in place to be able to do that. And what I've been hearing is they're basically volunteering America for a pinch. They're just saying, "Hey, you guys are you're gonna feel it." That's the way it works. So talking about buying a home then in this market and being strategic about it, the conversation has gone towards, buy downs, using, seller paid concessions to buy down the buyer's rate. Other strategies like that. Have you seen that? I mean, obviously you have. How is that working out? Are there specific situations where it works out better for others? How's that look?
Yeah. So, when I'm talking to my buyer, everybody, the person that relates to is, we're doing that one of two ways of evaluating if that's a good deal for our buyer. And one is, hey, do we need it to qualify?
Right.
Okay.
Right.
That we want to make sure we can close on that house from day one when we're negotiating. Right. Or two, hey, what are we comfortable with on monthly payment? How much are we taking away from the equity in the home?
Right.
Okay. To apply towards that rate, because being realistic, this product, I mean, it's a good product still. We're selling 5.75, 6.125 rates, anywhere between there right now. Still a good product, but it's a temporary product.
Right.
Anybody that's bought, the average mortgage lasts 3 years, and that's because somebody either sells or they refinance.
Right.
And so knowing that the Fed has communicated that they are going to increase rates until they start to see this inflation curb.
Right.
We're going to see them lay off of that.
Yeah.
And, I am willing to hang my hat on some of the experts I follow who've, they've said, hey, in the next 12, they've said next 12 to 18 months, we're going to see another mini refinance boom, because we're going to see those rates drop again. Right. And, for me, I'm just saying 12 to 24 months. My clients, as long as they can afford that payment and they're not, house broke, right? That's the key. And so everybody is a little different, but that's ways buyers are using to feel comfortable getting into those higher price homes with the higher rates.
Sure.
Yeah.
No, that's awesome. I mean, that's what it's not a one size fits all for everybody. Right. And it is. There are ways of being strategic, but that's one of the things that we do as professionals. You as a mortgage professional, myself as a real estate professional, is saying, listen, we're weighing out, risk reward here, and the one thing that I've been saying to a lot of people who are FHA buyers and VA buyers, 6-7 months ago, they were just, every single time they were just getting smoked. I mean, they just weren't even in the conversation. So now all of a sudden I'm able to go back and say, listen, you're a part of the conversation now. And listen, it's not that you weren't a great person. It's not even that you were fully qualified. It's just the way the market was going. They had so many offers. They could just take the cream of the crop, one they knew that was just going to completely work, wasn't going to be a problem, zero effort, zero stress, get in, get out. Well, now that conversation has changed. Days on market are hanging out a bit longer. So you were FHA, you're, VA. Now all of a sudden you're a part of the conversation again, and you're not having to take, and this is what, unfortunately, I think some people did in this last little rush in the last 12 months. They took the house they could get, not necessarily the house they wanted.
Yeah.
And so you're going to start to see, I would say you're going to start to see in about 12 to 24 months, I agree with you, also some little bit of some dissatisfaction with where some people are.
Yeah.
And they may want to reevaluate that move. Some may want to stick to it. It's just going to depend on the capacity. So I really do see kind of a real, just kind of a chaos coming in the next 24 months of just inventory, rate reduction, where it's just going to be a lot of things going on. So I appreciate what you're saying about, you've got to be able to calculate that risk of, hey, do we want to use the buy down? Does it actually make sense? Or do you want to just hang in there? And again, it's all on what we project the crystal ball of the market is going to look like. And sometimes that's just difficult. Historically, we've had recessions and whatnot, but there are some unique components to this one that just make it a little bit more challenging to read. So, hey, listen, where, if somebody wants to reach out and say, hey, I want to have a conversation. I like that Ben guy, which I would totally recommend. How do they reach out? How do they find you?
Yeah. Honestly, my cell phone's the best use.
Okay.
Email is, you get lost in the emails really quick over here. So my phone number is 253-651-3512. Sean will include it in on the link.
I will
that email does work too. It's just not as quick as response, but yep, and those are the best options, really. And honestly, if it's just a chat or you want to share your opinion on the market, I'd be happy to hear your opinion as well.
Oh, I don't know if you want to open to that one. That's good. All right, he's willing to talk.
Yeah,
hey, Ben, that was awesome. And hey, we will, like I said, I'm bringing on the best and the brightest. So next month we'll have Ben back on. So if you have any questions, put them in the comments below. I'll make sure that those get forwarded to him and his team as well. So. Hey, this is the Walker HT. Glad you stopped by. We'll talk to you later.